Hey, it's Ryan from the Dividend Investors Club, and this is the market trend tracker for the week of March 26, 2018. Whew, it was a rough week last week. Call it the Trump slump, call it what you want, but the market was down. All the major indices were down 6% last week, and it was mainly driven by Trump's decision to levy tariffs on China, and it definitely spooked the whole market out Thursday and Friday. And so there's a lot of stuff moving around right now. So let's take a look at the trends to kind of see what's going on and make sure this is not something we should be too concerned about longer term, and kind of see where the support levels are coming in at. But there's a few other things happening last week. Obviously, Facebook came out, some of their clients came out and were worried about data breaches. And that's definitely sent that stock into a free fall, which in turn hurt the whole tech industry and the tech sector. And so, we'll take a look at those trends here in a minute. But it was really the Trump tariff talk that sent us kind of spiraling out of control. And so let's take a look at the general market. What we've been saying for the past few weeks here since we had pulled back in early February is that we've kind of put in a range, if you will, and it bounced off of the 200-day moving average, back in February intraday, right? That was the intraday low, and then we closed higher that day, and then obviously we've got the peak of the range here was the high of early January or late January. So that's kind of the range that we've said that we're going to trade in, and you can kind of see we've just been bouncing along in this range. And we've kind of talked about not making new highs, but we've also said, hey, don't be surprised if we're going to test the lows again. And the nice thing about what happened Friday, if you can kind of see a silver lining in this whole situation, is it went down to the 200-day moving average and it stopped, and that's kind of where the pullback stopped on Friday. And we kind of ended towards the lows of the day, but I think it was kind of really pinpointing that, that 200-day moving average. You can see right here, we closed just above that 0.09% above the 200-day moving average. So that's held as resistance again, because early trading here on Monday, you can see we've bounced quite a bit. And so that's a very positive sign that we've bounced off of that support level again. So that's the second time now that we will have bounced off the 200-day moving average. And so what that says is this trend is still very much intact, this long-term trend. We've seen a lot of volatility, and I think we're going to continue to see the volatility. But as long as we keep bouncing off those trends and consolidate here, it gives us a path to potentially move higher and potentially break through that resistance level on the upside at some point. And so I think it was a healthy thing for that to happen, especially with the move we're seeing this morning. But certainly in a normal context of what you would expect, kind of given what's happened just the past few months. And so, again, I don't think it's something that's should probably go much lower than where we are. And, I think this is probably a decent buying opportunity to put some money to work in certain sectors that have pulled back. But just keep it in context that, we're probably going to bounce around here, and not necessarily shoot to new highs. But just kind of keep that in mind as you're putting new money to work. And, we're still very much in a normal context for this type of market. So, other things we're looking at, we did, Powell did raise interest rates last week, which, affected certain sectors and certain industries. But you can kind of see the spread here between the 10-year Treasury yield and the S&P 500 dividend yield has narrowed to about 0.8, so 82 basis points, and that's off of a high of a little over 1%. And so we've come in quite a bit on that spread here, and you can kind of just see, as the market sold off, the dividend yield has come up. We're at right around 2% now, and then we've kind of stabilized here just below 3% on the 10-year, and so. I think that's a positive thing. It may give us some kind of room to move into some of these higher yielding names that have really been taking it on the chin recently. Like utilities and real estate and consumer staples. that might be, we'll keep our eye on that, but that's again another positive kind of movement, I think, for some of those stocks. And then, you can see, again, we matched kind of that low, if you will, that we hit back in February. But if you look straight down here at the VIX, and I think another positive sign that we saw last week, and again, another kind of silver lining, I know it was a rough week, but, we peaked about 50 on the VIX intraday when we had that nasty sell-off in February. And we were right around 25. So we got back down to those levels, and the selling was pretty bad over 2 days, but the VIX only went up to about 25. And so I think that's another positive, kind of thing for the market to take a look at and say, the fear gauge didn't go off the radar like it did before, and it kind of stayed in a reasonable range for that move. And so that again just kind of backs up the theory here that I think we're just bouncing off of this 200-day, testing those support levels, and gives us some room to move higher from here. So I think all of those charts look pretty good. But a couple of themes just to point out, tech was just rocking and rolling, this year to date over the last 3 months, and you can kind of see what happened, last week. Let me change the color here of this pointer. So right here, I'm looking at tech. So that's been the story, right? It's been the best performer over the last 12 months. Best performer year to date, still between that and consumer discretionary. But we're up 9% going into the week last week, and you can see right here, tech sold off almost 8% last week alone. Some of that was driven by Facebook. Some of it was driven by the fact that that sector just had gotten ahead of itself. It started pulling back, kind of midweek last week, and just got crushed, on Thursday and Friday. And so, I think people like to point the finger at something. I think Facebook was kind of the straw that broke the camel's back there, but I think tech had just gotten too far too fast. And, now it's time to rotate into other sectors. And so, we see this time and time again. And I don't think it's something where you got to be too worried about tech. I just think it had to have a pullback because it had just gotten too far ahead of itself. I still think that, tech will be a leader going forward. And if we're going to make new highs, you better believe that tech's going to be involved there. But this is just one of those times where, take a look at some of those tech names that have pulled back because it's one of the last sectors to really suffer. And I think, now that we can consolidate here, it would be helpful to have a broad-based rally now, right? So tech's come back down to earth, and if we can kind of move up where we get, a kind of broad-based rally in all the sectors, that's what's going to help us, I think, move to new highs, not just, one or two sectors driving us there like it kind of has been in the past. So something to keep your eye on, but, I don't think it's something to worry too much about. It had to happen. I think it was, it was one of those things that, just happens with rotations. But the other thing to kind of take a look at, let me get rid of that, is that we saw some strength in some of the sectors that have been underperforming, right? So, one is utilities. And every sector was down last week, but utilities and actually energy was another decent performer. But utilities, I think what you saw is that, interest rates actually came down a little bit, and that hurt the banks quite a bit. So you can see the banks were, with all the nastiness that happened with tech last week, the banks were the worst performing sector because we rose interest rates. And the 10-year actually came down, just kind of given the fear that was going on in the market there, and so that hurt bank stocks quite a bit. But I do think those will rally back as well. So those, again, those were ones that had done pretty well year to date, and just had some quick pullbacks. But I do think I do like financials going forward as well, and I think that will be another sector that will certainly lead the market going forward. But you saw energy had a good week. Crude oil, you can see right down here. Crude oil was one of the only kind of positive asset classes along with gold and commodities that had a decent week last week, and of course you're going to see that start flowing through the energy stocks as well. But again, utilities, real estate had an okay relative week, and consumer staples had an okay relative week. So, those are some of the really weak sectors that have been, struggling, and you kind of like to see, some of that money flow out of financials and tech and into some of those other sectors. And, if we can get all of those to kind of move forward from here, I think that'll be positive. The other big thing I think that kind of needs to happen is I think, value needs to catch up a little bit as well. This is one thing that we pay really close attention to, on the asset class side. It's really this relationship between growth and value stocks. And you can see growth has absolutely led the market higher, and it's really been those large cap tech stocks that have really been leading the market higher, the FANG stocks, if you will. And you can see just, over the last 12 months on the far right side here, you've got, growth up 16% and value up only 2.5%. And then, that kind of extrapolates all the way down. Year to date, growth is about flat thanks to the big sell-off last week with tech. But value's down almost 7%. So value's really struggled, as of recently. But I think, again, as people start peeling back the onion a little bit and start moving forward on earnings, they're going to start looking more at value. And I think a lot of these value sectors will certainly play catch up. And I think one thing that's been hurting the value stocks a little bit is those value stocks tend to be some of the higher yielding stocks right now, just because of the rise in interest rates. And so that's really, I think, putting a ceiling on where those stocks can go for now. But I think once the market gets comfortable with, the rate hikes in the future, those stocks will certainly start to catch up. And the other thing, to take a look at here is dividend stocks, right? That's one thing that we follow obviously closely. That's the bulk of our investments. It shouldn't go unnoticed that dividend stocks are actually down 6% this year, right? So dividend stocks have been one of the worst performers this year, and I think that's again thanks to kind of the interest rate fears and kind of that discrepancy between growth and value. I think it's really taken a toll on dividend stocks, and we're able to find a lot of good dividend stocks on sale right now, and some good value in those stocks right now. So I think it's a great time as a dividend investor to really start peeling back the onion and finding those good stocks. I mean, you can get fantastic yields right now on a lot of stocks that 6 months ago were trading at much higher levels. Now you can get decent yields kind of across the board. You can build that diversified pool of stocks across all sectors. I think there's good value in pretty much every sector now on the dividend side, and you can get that nice 3 to 4% kind of average yield across your portfolio, because I think a lot of those stocks are offering very good yields right now. So that's another thing to just kind of watch, kind of see how that rotation with asset classes could potentially help dividend stocks down the road as well. So those are the big kind of things I'm looking at. But I think just in summary, big tech sell off. I don't think it's something to worry about. I think it's something that needed to happen. And we just I think we had a very positive bounce off that support level at the 200-day moving average on the S&P. I think we're seeing the yield spreads narrow a little bit here with the dividend yield and the treasury yield, and volatility's kind of been held in check. And so I think now is probably a good time to buy this dip, to buy this Trump slump, if you will. And don't be afraid. You gotta keep putting, keep executing your strategy no matter kind of what's going on in the market. And, I think all these kind of signs we're pointing to and all these trends that we track, are certainly pointing to the fact that, I think there's some decent upside from here, with kind of some limited downside. And so, I think that's kind of the marching orders for this week is, get that watch list together. Start looking at stocks that you want to own. Start looking at some of those value names, those dividend stocks that are paying good yields right now, and certainly diversified by sector. So last thing we always kind of take a look at is just the kind of stoplight chart here, and you can notice the difference this week versus past weeks. We've got no green showing here, which means all of these sectors have pulled back beyond their 50-day moving average. And so, we've got several that are still in the red, right? Consumer staples, MLPs, real estate, and utilities are all kind of in a downtrend, right? So these ones are ones that, tread with a little more caution because it is in a downtrend. But I think those are kind of where the deep value comes in. And I think the rest of the sectors here in the yellow, I think you definitely find, good value across the board in all of these sectors. So, look at your watch list, kind of see what's been trading down in those sectors, and you can see a lot of these have started to pull back to their 200-day moving averages. You can kind of see right here, financials kind of pulling back there. Tech is on its way down there. Industrials, you can kind of see pulled back. Healthcare, broke it. Materials broke it. So, these are all, sectors that I think, if you looked back a few months ago, we're all in a very, pretty strong uptrend. And now it's giving you opportunity to find some stocks in those sectors that could work for your portfolio at this level. So, again, it's something to look at, but I think this is a nice depiction of kind of where to take a look and, where to focus your energy. So that's all I've got for this week. Take care, everyone out there. Be safe, and we'll see you next week.
I think we all know that the stock market can be a scary place, especially if you're trying to go at it alone, but you don't have to do it. You don't have to be there alone. At the Dividend Investors Club, it's a community of investors. We're working together to grow and preserve our wealth. So if you like this video, please check us out at dividendinvestorsclub.com. Consider joining the club and joining us, and definitely subscribe to our YouTube channel by clicking the subscribe button below this video. Take care.